Do you know that liquidity is one of the most important things you need to understand in trading? Reason why is because liquidity is our market orders. Liquidity is our places that you place market executions, your buy stops, your sell stops, your sell limits, your buy limits, whatever you choose to do. Whenever you place a market order, you're obviously putting your money at stake. So there is liquidities, and inside liquidity, there are types of liquidities, and we have the liquidity void, liquidity and like the execution, which are the orders. Then the liquidity voids are your fair value gaps, your CB, your BC, your volume imbalance, blah blah blah, and so on and so forth. And fair value gap is one of the most talked about concepts in trading on ICT. Reason why is because fair value gaps are places where market makers show their mistakes. So it's like a missing data. It's a gap in between two candles, and that's like market makers leaving those gap. Let me show you what I mean on the chart. So this is a daily time frame, a gap in between two candles. This is a gap here from this high of the previous candle to the low of the next candle. There is a fair value gap. Same thing goes on the bearish candle. A gap between two gap. The low of the previous candle to the high of the next candle. This is how market is supposed to be delivering price. Every candle needs to be filled. Look at this. You are not supposed to see a gap, right? You're not supposed to be seeing a gap. Now you can see how this one filled. There's no gap here, right? There's no gap here because this guy came to fill. But whenever you see a gap like this, that means price was about to do something. Price was in a rush to do something. So with the cost of that rush, market always try to miss out data. They always give a gap. That's the mistake that you see there. Price always try to come back to refill those gap because that's like mitigating their losses, right? So whenever you see a fair value gap, just know price is most likely to come back for that that fair value gap. And how do you trade fair value gaps? Sometimes you can see a fair value gap on daily time frame, but once you go on lower time frame, you see price has filled those stores. That's why most times it is good, but you need to understand how to use it. Now, like I said, we have different types of liquidity void. We have the buy side liquidity also here. I forgot to mention that. This is we have the sell side. This is a sell side liquidity. I got taken out the sell side, just tiny pips. We have the buy side. So see, buy side liquidity taken. I mean, buy side liquidity has been taken to clear profitable shorts, meaning those people that were selling down to the side, that means they were holding their stop losses above. Now, what happened? Price came and took them out. Same thing goes with these people here. Sell-side liquidity. Sell-side liquidity has been taken to clear out what? Profitable buyers. People that were buying here, what happened? They were holding their stop losses below here. What happened? Now price came down, took them out. So I am going to be explaining buy side liquidity and sell side liquidity on the next video. But on this video, I am going to be talking about fair value gap. So if you're just joining me for this video, I'm the 10% trader, and what I do, I explain ICT in a layman understanding. This is an ICT series where I explain ICT step by step. So do well to like, share, subscribe, and comment, and forward this video to people to watch. So let's go back to the video. So like I said, on higher time frame you can have a fair value gap, but on lower time frame maybe price has filled that fair value gap. Let me give you an example of what I'm saying. Let's say I have a fair value gap. I've told you how to draw a fair value gap. Every candle has a high and a low. So you just draw your fair value gap in between those candles. And fair value gap must consist of three candles. The center one, the next, and the previous one. So you just need to have draw your candle and your fair value gap, sorry, from the previous candle high to the next candle low, or the previous candle low to the next candle high, or whatever. How you choose to draw it. So let's say I have a fair value gap here. Let me label it. I go, this is daily time frame. I go on 4 hours, 1 hour, sorry. So go check. You see, prices now. This is called refinement. On higher time frame, you will see a big time frame. A big fair value gap. Once you go on lower time frame, you can be able to refine it. That's how you can get your entry. You see how price came can also be used a for market entry. You see how price came back for the fair value gap, right? Now this is the 1 hour time frame. Let's go on 15 minutes to see if price has filled this whole fair value gap. You can see on the 15-minute time frame, I'm going to still refine. See how price came back to refill the whole fair value gap, then tapped on this bullish order block and then started buying. So it's still a mode of entry, fair value gap. Like I said before, fair value gap are missing data. Now, the reason why they give this fair value gap is because price was in a rush to go offload these buys here to take out buy side liquidity, which I'm still going to explain on the next video. To take out buy side liquidity. Now, with the cost of doing that, they left a gap, and now they need to mitigate their loss. That's why they came back to mitigate their loss and then react on the bullish order block, and then they started buying. So these are what you look for in the market: liquidities. And inside liquidities, you can start with fair value gap. You need to find fair value gap whenever you want to take a trade. If there is no fair value gap before your entry, I think you need to look for another setup, because fair value gap are one of the essential stuff that you look for in the market, because don't always like to lose. They always want to come back to mitigate their losses. Do you understand? Sorry, my network is disturbing. So like I said, they always want to come back to mitigate their losses. So from higher time frame that we saw a bigger fair value gap, down to the lower time frame that we're not seeing a smaller fair value gap. Now let's go back to the higher time frame to see how much we would have lost just because we are looking at the higher time frame fair value gap. You can see from this whole fair value gap that we cut here, price move, we now see how we refined it down to this side. That's why I said sometimes when you see like a full fair value gap on a higher time frame, go on lower time frame to understand where to catch your trades. And like I explained on the previous video, higher time frame just summarize everything. Lower time frame is where the market is taking place, because it's all about daily activities. Whatever price wants to do in the next month or in a 1 month time. You need to start from every day before we now summarize to a monthly time frame. So go on lower time frame to see what the market makers are actually doing, right? So if fair value gap are mistakes that market makers are doing, so how well can we use it for our own benefit? It is to find a means of entering using fair value gap. Most people don't use order block for entering. Most people don't use what is it called? Demand zone, supply zone, blah blah blah. They like to use what? Fair value gap, because that one's like setting for them that price is always coming back for this space, for this guy. Let's look at the chart and see how to use fair value gap for our entry. And if truly market are always coming back for maybe most fair value gaps. Now I'm going to use this range from this to this guy. Remember, I explained what is a range on the previous video. Go and watch. So this range from here to this guy, I'm going to mark out series of fair value gap. So this is a fair value gap. 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 I told you how to mark your fair value gap. This is a fair value gap. Uh, This is a fair value gap. So what you do is you just mark. Sorry, yeah, this is the fair value gap. This is where the fair value gap started, from high to the low of the fair value gap. Then you buy from the 50% below. And remember, it is a fair value gap, not another block. So if you're giving your stop loss, if you're putting your stop loss, always give more pips below. Like I said before, when you have a fair value gap, you always see other block before that fair value gap. So try to put your stop loss below that other block. So this is another block and this is a fair value gap, because for there to be a fair value gap, I mean there need to be an originator move, something that starts that move, right? So this is the guy that started this whole movement that left the fair value gap. So I'm going to leave my stop loss below that stuff. You can still give more few pips down, right? Then maybe you're targeting like how many weeks to reward. Now we've got 1 to 2, right? Easy peasy, 1 to 2 weeks to rewards. Now, most people you want to give more pips, which is not advisable. I always try to explain what is going to be favorable to you. So let's just leave this. The second guy, which is this, right? We draw our stuff. We buy at the 50% of the fair value gap. We put our stop loss below the guy that sponsored that move, which is this. So I'm just still gonna give like more space. Yeah. So we're able to call like 1 to 4. Easy peasy. Now let's go over to the next one. So that's how you catch. You put your what? Stop loss below the guy that sponsored the move, which is this. We're able to cut again 1 to 4. Okay. Uh you're not going to win every time. That's forex for you. So let's say we put our this thing here below the move. The guy that sponsored the move, which is this, still able to cut 1 to 3. Okay, you're lucky this time. Draw a fib. This is not a fib. This is I think a green box or something something. If you want to find this here, look at it here. Gain box or GAN box, whatever. So you put your this thing, your stop loss. Your stop loss should be below the guy that sponsored the move. Now you will be able to cut 1 to 2. That's easy. Yeah, price wouldn't give you 1 to 2, took you out, blah blah blah. You cannot win every time. So that's how you can catch series of trades, and you can be stacking when market breaks a structure. I've explained, see how everything comes in line now. I've explained uh, break of structure. I've explained market structure. So now you now use it, you now join the two and use it for your benefit. Now this is a market structure and this is a bullish trend. If market is breaking highs, respecting the low, that means we're on a bullish trend. So when price break a structure, what happens? We always want to wait for a retracement, and once price retrace, you will now find this is an entry mode. You will now find the fair value gap. That's how you'll be doing stacking. You'll be stacking. You'll be stacking until price now do what? Breaks the low. When price breaks the low, is giving you a signal that, oh, I'm about to change a market trend. Now see, now price started like selling. This is on the lower time frame because this is 1 hour. Overall, we are on a bullish trend. We are on a bullish trend on the daily time frame. So, so on and so forth. That's how to use fair value gap for your benefit. This is how to use what? Fair value gap. It works on all time frame. 15 minutes, 1 minute, 5 minutes, 1 hour, the daily time frame. Price always leave what? Gap on every time frame. And that's how you use it for your benefit. So I'm going to stop here. See you guys on the next video. Stay safe and trade well.